Hello and welcome. Today we're going to be analysing Alibaba, ticker symbol BABA. Full disclosure, I'd already owned some Alibaba stock, but with the recent sell-off I've decided to do another analysis and come up with a valuation to see if the expected return is worth me increasing my current position. On this channel, we're going to aim to find great businesses that provide market-beating returns by buying and holding them over a medium to long-term period. First of all, we will be researching the business itself and making sure we understand the bulk of its operations. We will also be looking at any recent news or events that have affected the business or its stock price. We'll then be looking at historical results of the business, focusing on top-line revenue growth, EBITDA and earnings growth, free cash flow growth, and the health of its balance sheet. From those historical results and research conducted, we will be coming up with a narrative and numbers valuation for Alibaba. The narrative will provide us with the how is the business going to grow and be profitable. The numbers will provide us with the value, allowing us to estimate an expected rate of return. So, what actually makes up the Alibaba group? So at first we've got core commerce, which makes up the largest portion of the business and contributes to all of the profits. So here you've got business to consumer services, consumer to consumer, and business to business. Next, we've got Alibaba Cloud computing segment, which is the fastest growing segment of the business. Currently makes up about 8 to 9% of the business, but it's growing at 60%. Next up, digital media and entertainment. This is mainly made up of Youku and Alibaba Pictures, I believe. Still growing. It's growing at about 12% actually at the moment, year on year. And lastly, innovation and others, which I'd be lying if I said I knew too much about, but it makes up a very small segment of the business. One thing that's definitely worth noting is that Alibaba is the largest e-commerce company in the world when measured by gross merchandise value. So that gives you an idea of the size of Alibaba and the scale in which it operates. I mean, it's even 3 times the size of Amazon when measured by gross merchandise value. And ahead of JD.com by some way, as you can probably see, which is their main competitor for e-commerce in China. So let's talk about the stock, let's talk about the company, and let's see if we can form an opinion on if it's a buy after the recent sell-off. First off, let's take a look at the stock chart. As you can see, it had quite a good run up as of 2020, the start of the year, and then we got up to November and October, and the stock started to sell off. So we've dropped down to about 254 there, scaled back up to about 270. I wouldn't be surprised if it started to trade back down again, but as you can see, a big drop there from the top. I think that's about a 20% drop overall. So I think most of you will know by now the reason why Alibaba has been selling off, but here's a quick overview. So the Chinese government suspended the IPO of Ant Group, which Alibaba owns a 33% stake in. They also drafted anti-competitive practice to target the usage of data in big tech companies such as Alibaba. These two issues sent the stock falling despite posting huge record sales on Singles Day. The company also delivered better than expected quarterly results. However, investors were more focused on the noise surrounding Ant Group's IPO. Alibaba's current market cap is $706 billion US. Sounds like a big number, I know, but let's see if the fundamentals justify it. So if we look at prices here, currently the stock's trading at a normalised PE of 28 times multiple. The normalised PE is not including the recent cost of shares issuance in Q3, which sort of dragged that net income to shareholders down. But obviously that's a one-off expense. I mean, we don't like to see it, but it's a one-off expense. Free cash flow is trading at 25 times. As owners of the business, we want to be focusing on free cash flow. It represents the cash a company generates after accounting for all the cash outflows and cash supporting operations to maintain the business. This cash essentially belongs to us. Price to EBITDA, 37 times. For the valuation, we're going to be focusing on EBITDA instead of net income. It's just a more precise measure of the business's performance since it's able to show earnings before the influence of accounting and financial deductions. We can also more accurately predict an exit multiple or terminal value using the enterprise to EBITDA method rather than the PE ratio. I just want to point out these are trailing 12 months figures. We're going to actually be using 2020 fiscal year figures for our valuation. Overall, 24 times, 25 times and 37 times But 25 times cash flow for a company growing at upwards of 30% at the moment, that doesn't look bad on the face of it. Okay, so here we are, Alibaba's historical results. Feel free to pause the video at any time and just digest some of the numbers. Just to clarify, these are all US dollars. I'd also just point out that I'm using the past 5 years for valuation purposes, as Alibaba's still a young company, was achieving some really high growth rates about 6 to 10 years back, which is good to know, but it would distract us from the averages we need. Firstly, top line revenue growth averaged 43% for the 5-year period. That's a fantastic number, and it ticks the first box for us. I'm not sure we'll quite see 43% for the next 5 years. Last year's growth was a bit more like 30%, and I expect to see something like that in 2021. Next, let's have a look at EBITDA. So EBITDA has grown from 5 billion to 19 billion since 2016, averaging 36% along the way. We definitely like to see that. No surprise really that top line growth has been growing at a higher rate than EBITDA, mainly because core commerce has been the sole producer of earnings, and segments such as cloud and media are very much still in the high growth phase and yet to contribute to profit. Earnings per share again has been very high, albeit a bit more volatile, which is another reason why we tend to focus on EBITDA and free cash flow as a valuation metric. But nonetheless, EPS has had some great moves. I will just point out that net income here in 2020 is a little bit higher than the EBITDA number, and that usually, obviously, it's not a usual thing to see, but what that is it's just income made up of investments and interest income that Alibaba receives from investments such as Ant Group and stuff like that. Return on equity, return on invested capital, both shown here. You can see they've both sustained, quite high levels throughout the 5-year period. I'd say return on invested capital is probably a better indicator anyway, but they're both good measures of efficiency in the business. Now, if we take a look at the balance sheet details, although it's not a full balance sheet, it shows us most of what we need to know for the valuation process. As you can see, total debt has remained flat at around 9 billion. Which is quite remarkable, and shows us that Alibaba is definitely a self-sustaining business, meaning that it only requires cash produced from itself to maintain and grow the business. That's really a characteristic of a company that can compound at very high rates over time. Next, cash on hand. So cash on hand has grown at a near 30% compounded rate over the 5 years, with total shareholder equity growing at around about the same rate as well. As you can also see, the share price has moved up very nicely from 2016 as well. I think you would have made about 35% compounded from holding Alibaba during this period. However, if you look at the historic PE ratios and EV to EBITDA ratios that we've got here, the stock never really got horribly expensive, in my opinion, considering the amount of growth that it was achieving as well, both top and bottom line. Next, if we look at the cash flow statement down here, we have cash from operations growing at a similar rate to earnings, which is what we'd like to see. We always want to keep an eye out, see there's no funny accounting methods being used, but it looks okay here. If you look at CapEx as well, so CapEx really here is demonstrating how capital light Alibaba's business is. They really don't have a huge amount of operating costs, and as we pointed out earlier, this is definitely preferable in businesses in order to achieve high compounded growth rates. Free cash flow, as you can see, is gushing cash, really. Free cash flow margin of over 25% and growing at an average rate of 33% year over year. For a business selling at 25 times free cash flow, these are great numbers. The free cash flow yield is essentially the inverse of price to free cash flow. It's telling us, though, how much free cash flow we are receiving as a percentage of our investment. It's also going to be the metric we use for the free cash flow exit value or terminal value. Now, let's start thinking about valuation and the valuation part of this video. As with all good valuations, we need to start thinking not just of the numbers, we need to start thinking of the story behind the numbers and the narrative behind it, and the how. How is Alibaba going to grow? What tailwinds are there? What secular trends are there that are going to help Alibaba grow? So I'm going to run through a list of tailwinds and headwinds that could have an effect on Alibaba's growth. Okay, so just listing them out, we've got the tailwinds here. So first one, the move from retail to e-commerce, moving at a very fast pace, and Alibaba is obviously in a prime position to benefit. The Chinese economy growing at a pace of 8 to 9% per year, and the economy forecasted to grow to 37 trillion by 2030. So that's almost double the size of the current US economy. Third, China's middle class expected to equal 700 million people by the end of 2020. This is twice the size of the USA's middle class currently. Fourth, Alibaba is yet to contribute to earnings, however it is growing at a rapid rate and will no doubt start being profitable in the coming years. If we compare Alibaba Cloud to its peers, AWS, Azure and Google, it has the potential to grow much larger and likely produce profit margins of around 25 to 30%. Fifth, Alibaba has various investments that will likely grow and continue to provide investment income for them. And then sixth, Alibaba has a huge cash position of $60 billion cash on hand with virtually no debt. So that's going to put them in a prime position to capitalize on high return opportunities that present themselves within China and Asia and who knows internationally. Some headwinds or going concerns, just to mention, we've got the Chinese government preventing Alibaba from getting too big, slowing growth and breaking up the company. In my opinion, this seems unlikely, but never say never. Trade war intentions with the US, preventing Alibaba from doing business online with US consumers. Obviously, they have the largest Chinese business to US consumer online business out there. Ant Group's IPO and valuation dropping 30% to 50%. Due to new codes of conduct on credit facilitating. This will likely be a real problem and will have some effect on Alibaba, albeit in a small way. Management issuing new shares, although it wasn't a big dilution in Q3, they issued some shares. Still, I don't know what the reason was, but it still seems unnecessary considering the amount of cash they have on hand. Okay, so keeping that narrative in mind, I've come up with this forecast based on the company's past performance, current position and their runway for growth. We've got our EBITDA projection here, which I want you to keep an eye on here. So we've got 126 billion we think it's going to get to by 2030. So an average rate of about average growth rate of about 21% over the period. Cash in hand is going to grow at a little bit of a smaller rate. I'm guessing that they're going to reinvest a lot of the cash that they get, or at least try to. So that's at 14%. Average growth rate. Free cash flow projection. So we've done a free cash flow forecast down here where we've projected that off of the current growth rate of 30%, we think it's going to drop slightly each year, being fairly conservative and saying it's going to drop to 12.5% by the end of the period. Although I really wouldn't be surprised if even by sort of 2025 to 2030 that the growth doesn't actually slow as much as that. If you look at, again, pointing to Amazon as an example. So up here, we have them both coupled together. Free cash flow projection. What we want to sort of check is that they're about the same sort of growth rate. So we got 20, 19, and 21. So that's fine as long as they end up a figure near to each other. And by the end, we've got free cash flow slightly above EBITDA, which is the same sort of relationship that we have over here at the moment, in terms of cash flow, free cash flow being a bit above EBITDA, mostly because of that investment income that they have coming in. They invest in so much. And then based off of the 10th year EBITDA, we've got a enterprise value, which we're doing a enterprise value to EBITDA multiple of 22.5. So how we sort of calculated that out, we'll go over that quickly now. So we've got 30 as the average EV to EBITDA multiple that we've got here. I'm saying that it's going to be a little bit lower than that, but it's going to be lower than that by 2030. So we're going with 22.5 times multiple there, and you'll see there's a bit of a relationship with what we've got here in the relative valuations to that as well. So I forgot to explain this beforehand. So this table here we're looking at is the relative valuation table for some similar companies. So we've got the FANG stocks, JD.com and Tencent. Average between all of them is 32 times EV to EBITDA. Online retail as an industry is actually 22.8 times EBITDA. So we're just using these in our valuation to try and get our exit multiple. As you can see, 22 times does look fairly conservative when you look at some of the valuations we've got here. Okay, and then up from the enterprise value of the multiple, we're going to be adding, subtracting, debt, adding back the cash so we can get a market cap of 3 trillion by 2030. Sounds like a big number, but I guarantee by 2030 that won't sound like a big number to you anymore. Share price with the expected shares outstanding, we've grown shares outstanding by 0.5%, which was the average over the last 10 years, and that gets us to a share price of $1,093 per share, not accounting for any stock splits that might happen along the way. That's from the EBITDA multiple. So we've also done a free cash flow projection down here, which I mentioned earlier, but what I didn't show you was the exit multiple here as well. So we're looking at free cash flow yield here to calculate the sale price or exit multiple. So we've gone with 3.78%, which is the average over the period. It's a little bit less than now, but this is just the invert of price to free cash flow, basically, and that gets us a exit value of 3.6 trillion in that period. And then, so we put both of them together there, we get an average of $1,193 per share as of the 10th year. And how that looks in a IRR calculator we have here. So what we want to look at is how much cash are we collecting over that 10-year period, versus our principal investment of that $265, and the money that we're going to be receiving back from the sale of the investment or the exit of the investment. So we have our total cash flow column here. As you can see, we've got a negative number for the first year where we're putting out cash to receive some later, and then all in the following years we've got our totals here. So the IRR, and it's actually very easy to calculate IRR, it's an Excel formula, equals IRR, and highlight all of the cash flows over the period, and it will give you an IRR, internal rate of return. So we've got an internal rate of return of 25% expected off of the current stock price. This was $265 at the time. We've actually put that up to $270 that it is now. It dropped down to 24%, but we're there or thereabouts. Discounted cash flow valuation. So this was just a quick one. We're just looking at the intrinsic value of all the future cash flows and discounting them back to the present day at a required rate of return. Sorry, I don't know what has happened there. Why are they not in my percentages? So required rate of return 15%, margin of safety 25%. I usually go for a higher margin of safety, but I'm fairly positive that Alibaba is going to grow at a good rate into the future. So my margin of safety is 25%, which actually I could go higher than. I could even go up to 35, and I could still be at the buy price. So let's look at the assumptions. So the assumptions that we've had, it's always important to factor in the assumptions, because we're always going to have assumptions. No valuation or DCF is going to be accurate. I think we just have to accept that. It's good to look at how far you have to stretch those growth projections to actually get to a rate of return that's acceptable to you, or get to the buy price in terms of the DCF valuation. So it's just good to look at it. But our assumptions we've got here, so we've got an average EBITDA and free cash flow growth rate of 20%. Revenue equates to about the same, 20%. EV to EBITDA multiple of 22 times at the end of the period. Cash on hand growth of 14%, which factors into the enterprise value, and a cost basis per share of $265 or $270 we've actually changed it to. So we've got a similar thing here. We've got a little 5-year projection. So this is just a forecasted period, but I've just taken out the last 5 to 10 years. It's sometimes nice to look at this as well, see how the IRR compares. So we've got similar numbers. I'm not going to go over them exactly again, but the difference is we've got an enterprise value, still an exit value of 22 times, and less the debt plus the cash, we get our market cap
share price of $664 as per EBITDA calculation in 2025. Cash flow, fairly similar. We've gone with a cash flow yield here, 4%. I've actually been a bit more conservative on this one and said that after 5 years, the cash flow yield is going to go up, which means that it's actually selling cheaper than what it is now, which is sort of a conservative estimate, but average of $674 per share in 2025, we think, with that exit multiple, which equates to an IRR of 33% as of the $265 upfront investment you'd have to make now. When we put that into a DCF, it comes up with an intrinsic value. Obviously, it comes up with an intrinsic value of $392 per share off of a required rate of return of 15%. So we're just discounting those cash flows back to the present day. These cash flows back to the present day on a required rate of return of 15%. Margin of safety, 25%. We have a buy price of 294. So you can see comfortably under that that buy price currently. So in summary, it looks like Alibaba is indeed a buy at the moment. This is just my opinion. These are my forecasts. They're definitely not definite and will likely, be wrong one way or the other. But what I'm aiming to do is give you a good idea of whereabouts Alibaba is in terms of where it's going and what sort of value you can get from it today. Anyway, I hope you found it useful, and let me know what other companies you want researched and valued.